Okay, let's go ahead and get started. Welcome, everyone, and thank you for joining. My name is Steve Kiefer. I'm the CMO at Ordway, and on behalf of both Ordway and Spiff, our partners hosting the webinar, I want to thank you for joining the session on how sales and finance can align for the economic downturn. I am joined by three panelists who I'm going to introduce in just 1 minute. But before we get to that, let me cover a few logistics and housekeeping items. And some of the very common questions that we typically get asked. So first of all, although you can see and hear us, we cannot see and hear you. So everyone is on mute and your camera is off by default on this webinar platform. So no need to look for the mute button. We also typically will get asked whether you're going to be able to have copies of the slides. We're actually not going to be using many slides today. We're going to keep this a little more informal and conversational. So there won't be any slides to share. However, we will be sending out a link to a replay of the recording. So if for some reason you need to leave us early, or you have a colleague that wanted to join but wasn't able, or maybe you're just blown away by the fantastic discussion we have here and want to hear it a second time, that will be easy to do. And finally, I have prepared a list of questions as the moderator for the session for the panelists, but we'd love to get some real-time questions from those of you in the audience as well. So on the right side of the Goldcast panel, you'll see a button for Q&A, and I'll keep an eye on that during the session and would love to take a handful of questions real time. So you didn't come to this webinar to listen to me, you came to listen to our panelists. So let's go ahead and start introducing them. And we'll go right to left, starting with John Young, who's had an amazing career at well over a dozen different tech companies in senior finance and accounting roles, just landed a new gig. So John, do you want to tell us a little bit about your work at MBS Highway and your new gig?
Yeah, so MBS Highway is a SaaS-based subscription platform for the mortgage loan industry, providing content and financial tools to mortgage loan originators to help them be more consultative and less processors. So help them to convert more loans or prospective loans to actual loans. Highly successful, 43,000 subscribers on the platform, 1% churn, and believe it or not, over 60% EBITDA. From the platform. So highly successful, experiencing 40% growth per year. So very, very interesting platform. And as we'll get into later, the typical issues in a subscription-based business and the need for information and data to actually understand what the activity is in our base.
Well, those are some amazing metrics. Rule 100. I'm envious. Yep. So looking forward to hearing more about that. Why don't we jump next to Kieran, who is the CFO at Alloy.
Steve, thank you for the opportunity. And hi, everyone. My name is Kieran Hebar. I'm the CFO of Alloy. And Alloy is a SaaS company that provides an infrastructure solution for financial services clients, for example, banks and fintechs, for them to do identity verification and fraud mitigation in the context of onboarding new accounts and constantly monitoring how they're doing. And we do it through an API-first approach, where all our customers have to do is to build one integration into Alloy, and they can write their decision rules, and we bring best practices in the Alloy platform.
And a little bit about before that, I understand you're a recovering venture capitalist.
Recovering, yes. Recovered, because this is my third gig on the VC-backed startup operating role. You're right. I was a VC for 10 years, where I invested in B2B enterprise software companies. And I was sort of tired of giving advice to entrepreneurs when you don't know if that advice is taken or it's impactful. I wanted to solve real hard problems. So this is my third operating role.
Great. And I apologize, Kieran, we got your last name wrong on this slide here, although
I was going to say, as the revenue guy, there's no more committed CFO than someone who changes his name to the company.
Yeah, actually, I changed my name officially. That's it.
Okay, and last but certainly not least, Matt, who's the Chief Revenue Officer at Spiff, who's the co-host for the webinar. Matt, you want to tell us a little bit about your role currently in Spiff and some of the things you did before?
Sure. Thanks, Steve. Appreciate being here. Always exciting too to not just have a panel with sales leaders, but diversify that out to finance leaders. So I'm excited to get into the dialogue with Kieran, and John today. So Matt Garr, CRO at Spiff. Quick background, I was with Cornerstone On Demand in my early days, one of the early unicorns, with them from about 25 million to 450, pre-post IPO, significant global scale, really good early run. Then moved to a company now called Emburse. It was Chrome River originally, joined them at about 28 million to about 200 million. It wasn't the easiest time selling travel and expense during the COVID years, but we still managed some pretty expansive growth. And was a Spiff customer, as a matter of fact. So I've used a lot of different commission platforms. That's what Spiff does for a living as a sales and revenue leader, and was so ecstatic by the product and solution that I decided to move over to Spiff in May of last year, running all things revenue for Spiff. So we provide a modern platform for commission and variable compensation, very much oriented towards your administrator, your RevOps team, and especially focused on the sales experience as well, with tools that tie Spiff and commission estimates directly into the Salesforce environment, where a lot of our sales teams do their jobs every single day. So exciting space to be in, great growth trajectory for Spiff, and I'm excited to be here today to chit chat a little bit. So thanks, Steve.
Yeah, the sales compensation space come a long way. I remember 5 or 6 years ago struggling through trying to Exactly implementation, which was a nightmare. It's amazing how much easier it is these days. Yeah. Good stuff. So I want to thank all of you for making time this week. I know it's a busy time with everything going on in the banking sector on the finance side, and we're about 10 days away from the end of the quarter. So I'm sure Matt's got a pretty busy week. So let's go ahead and jump into it. First, just big picture, right? So the world has really turned upside down in the past 18 months. I mean, we've gone from a mindset of growth at all costs to much more of a conservative type of posture these days, where we're balancing growth and efficiency. And I'm just curious at a high level for each of the three of you, how are you doing business planning in an environment like this? How are you making sure sales and finance are aligned? In normal circumstances, we'd sit back in November, December and make a nice plan for the whole year. Mm-hmm. These days it's hard to predict what's going to happen next week, let alone next quarter. So how's everyone staying aligned and forecasting? Maybe Matt, we'll start with you from a CRO perspective.
Yeah, sure. I think what's occurred in the last year is we've moved to a lot more shorter sprints as it pertains to planning and execution, and ensuring that the revenue coverage is going to be there to fund the investment, as opposed to at least, in the year and a half or before the last 18 months, it was a lot of invest up front and chase the growth, and it'll be there because the market was obviously reinforcing that. So I think that's one thing that is wise for all, revenue, but also finance partners to be focused on, is just when is the time for the incremental investment. We're doing a lot more measurement of pipeline coverage, and true efficiency at the sales level before we make those incremental investments as well, even down to which segment, is the right one to be investing in right now. So I think that, the risk of churn, depending on your ICP or the segment and industry that you're selling into, is real. So I think that's another thing that we're very focused on from a net new acquisition perspective, is which sectors have been the most hit in the short term across our customer base, and how can we both ensure that our value prop for that ICP customer still resonates even in times of downturn, but also it represents an opportunity to incrementally add some other industries and segments and address those that might not be as impacted by some of the short-term pullback. So and just in general, I think there's a higher focus on overall ARR and NDR trends across the revenue business. It's not just bookings units. While that is vital, of course, from a growth perspective, and still what a lot of my teams are focused on, each week with the E team, we're ensuring we're measuring all health areas of the business from a top line perspective. We're not, rule of 100 yet, John. We'll work on that, I promise. But we're very, very top line focused, but with an eye on consistency and a consistent ARR growth that takes, churn, expansion, and net new into account.
Okay, great. Maybe we'll move to Kieran next. How are you guys managed through this at Alloy?
So at Alloy, it's the same philosophy that I have followed for about 7 years, being a CFO at my third company, which is it's always sustainable growth. I mean, in some periods, investors would put pressure on you to kind of increase the top line, but philosophically, I've always operated in a mode of doing continuous scenario planning. So my team, even now, on a monthly basis, they look at a few different elements of forecasting. It's the top line, new bookings, it's GDR, it's NDR, it's cash burn, and we're saying, are we heading in the right direction as it relates to this combination of 3 or 4 important things. So what it's done now is, it's a more collaborative approach to planning. So it's the sales leaders, CS leaders, RevOps, finance coming together. But also, this downturn has really been a blessing of some sorts, because we've gone back to first principles, and we're evaluating who is our real ICP. For our real ICP, is there a different sales motion or a different lighter footprint product, especially for some segments that are very impacted during this economy? And so it's brought back a level of thoughtfulness that should always be in every company. And also it helps that, Alloy is essentially a very frugal culture. So it wasn't that much of a change for us, except that we're saying that, okay, it's not growth at all costs, it's sustainable growth. It's what we always believed in.
Good. And John, how about from your perspective?
Yeah, from my perspective, the major thing we've done is remove the chaos from the sales process and put structure in place. And by that, what I mean is we brought in a mature CRM, we've implemented it, and now we're focused on those metrics. So the cadence, the source of leads, the conversion ratios of leads to actual subscribers and so forth. And we're more focused on that. So no longer is it just pure chaos and buying the revenue. We're actually focused on those metrics and where our dollars are being spent to get those leads and improving that conversion ratio. So that's where we're focused. And that's a major shift for us in the past 18 months.
It's an interesting point that in the face of potentially slowing growth, you're investing in efficiency then as the CFO, right? So I would think then, as you're seeing things cross your desk that the team wants to invest in, I can only imagine that's one of your key points is, how is this going to drive efficiency to the business? Maybe I'll invest a little now, but I want to make sure I'm seeing efficiency gains pretty quickly. So it's cool to hear you're actually investing. That's cool.
Yep, 100%.
Yeah, I think the one comment I might make, bringing back to Steve, as you mentioned, I was a VC for 10 years. And I've been through ups and downs through the 2008 cycle when I was a VC. One thing is sure, your company a VC-backed company is there to win. Now, if you kind of reduce your chances of winning, that you focus on efficiency and profitability so much that you miss the opportunities during this window, it's hard to recover. So it's always a balance between what is win, redefine it, invest in it, but do it, as Matt said, in a very operationally efficient way.
It's a great point. I had that exact conversation with our CEO coming into this year, because none of us at Spiff, we're growing over 100% year on year. It's been a really cool period of expansion and growth, and we had that exact conversation. He's like, "Listen, I want to ensure we're focusing on efficiency, but I do not want to impede our growth path, right? Because even in a slowing economy, when you think of a solution like ours, there's still significant demand out there, and we don't want to slow down too much." And it's those conversations and the timing of those investments that are so vital. And I do agree, it's like a period of higher collaboration and partnership between finance and go-to-market right now.
So on that note that Matt was talking about, in terms of new customer acquisition, I mean, it seems like a lot of our customers are cutting back on spend a little bit. I mean, everyone gets conservative, starts to pull budgets back when we start heading into a downturn. Sales teams are having to work a lot harder in 2023 to earn every new dollar of ARR. What are some of the changes you guys are taking in terms of the approach to new customer acquisition? Are you changing, Matt, you talked a little bit about changing messaging, positioning. Kieran talked about first principles and ICP and product market fit. Let's talk about new customer acquisition for a minute. Maybe Matt, again, I'll start with you on this one just because you're more on the sales side.
Yeah, I mean, the fundamental value of a platform like Spiff's, I think, remains the same. It's a question of what's most important, in the minds of the CSOs, CROs, and CFOs that we sell to right now. And I think during the boom times, it was focused on, visibility for the AEs. And as you scale your AE team up, make sure you have modern tools in place so they know exactly how much they're going to get paid and why and when, and trace it and have the ability to see that. And that's still important, but now you pivot the positioning and the messaging and ultimately the value prop to a little bit more around revenue preservation, revenue growth, optimal revenue and commission alignment, and kind of de-risking even if you've gone through a period of layoffs within your tech organization, if that's where you play, you still have those top sales professionals that represent your revenue growth. They're the front lines of your revenue growth for the coming period. And it's arguably even more important to ensure they're engaged, that you have the right commission plan in place. And I think ultimately and optimally that your commission plan is aligned with your revenue desires. And that's one thing that sometimes, believe it or not, gets missed. Like the CFO might, and the board and the CRO will roll out the revenue plan, but did that get translated into the commission plan? If it didn't, you've already got a bit of a gap, and that's one area that a business like Spiff can help. But if it did, then you want to have the right tools to reinforce those behaviors that say, if you do these things, you're gonna peak your commission, and guess what? That's going to peak the revenue outcomes. So it's really just tying things to revenue preservation, growth, de-risking, and ensuring also, back to the CFO topic, that the ROI is clear. So John was talking about investing in efficiency. The CFO ultimately is going to review likely every software purchase over the course of the coming period. So when you're, if you're selling to a frontline administrator or someone who's going to use a tool as a sales organization, we have to make sure that it is clear, not just to them how it'll help their day to day, but how it's going to help drive broader efficiency across the business. Because when it crosses Kieran and John's desk, they're going to look at them and say, okay, it'll save us 10 grand or 20 grand maybe over what we're spending today. But why now? Why is this a worthy investment now that's going to propel efficiency, once we get it up and live? Because there's always costs to implement and change management and those things. So those are some areas that we're really having to enhance how we work with our finance and revenue teams in getting Spiff out there.
One of the other things I think is interesting in this environment is sales hiring. We've had this, again, kind of a dramatic change in the way we think about sales hiring. I remember when I joined Ordway in 2021, we go to the board meetings. Why haven't you hired more salespeople faster? Today it's, why do you have so many salespeople? Why aren't they more productive? Do we have too many, sort of thing? How are you guys thinking about incremental sales headcount in 2023? Have you put things on hold? Have you slowed it down? And then, once you get them hired, is there a higher, the same expectation around productivity and onboarding, enablement, that sort of thing? Maybe Kieran, we'll start with your perspective from Alloy.
Yeah. So yes, we are hiring for the same reasons that I mentioned. It's all about winning. But, we had to go back to the drawing board and ask ourselves, if we hire a new seller, do they have everything else around them to be successful? So one, pipeline. So we said, okay, we need to, invest in the pipeline growth area, enablement. So we brought in people to hire, to enable our sellers, training sellers to really be masters on the product knowledge, ICP segment knowledge, and so on and so forth. So we sort of started by investing in those areas first, and then say that, okay, now the conditions for a new seller to be successful are there, so let's increase headcount. But also we have done it very methodically.
Mm-hmm. Got it. Revenue, of course, doesn't come just from new customers and salespeople. A lot of it comes from your existing accounts. And at Ordway, we work with a lot of SaaS companies. One of the things we're hearing a lot from our customers is they're just, they're getting hit up at renewal time with customers that they have too many seats, or they feel like their usage commitments are too high. They need concessions on pricing and discounts. And, some of them are taking the approach of, we're going to play hardball. We're not going to renegotiate contracts midterm. We're going to try to retain every dollar that we can during renewals. Others are offering a lot more flexibility and taking a longer term view on, hold on to the customer, even if it's a contraction in the short term. Interested in your perspective on how you handle those kinds of challenges, thinking about short-term ARR targets, but also long-term customer growth and retention. Maybe John, you could comment a little bit on how you dealt with that at MBS.
Yeah, so at MBS, 70% of our revenue comes from enterprise accounts. So it's spread across roughly 250 enterprise deals. And yes, there is pressure. The mortgage industry, as we know, rates are up, deals are down. So we're getting a lot of pressure. So what we've done, when we've been confronted with those issues, we're actually putting temporary reductions in place for our enterprise accounts that come to us that are simply a 3-month, worst case 6-month temporary reduction in their enterprise fee, where it'll rebound once we come through the rate issue, which we think is going to resolve in 4 months. So that's primarily what we've done. And then we've additionally stepped up our customer success efforts. We do a lot more webinars. We do a lot more trainings for our customers to make sure they're using all aspects of the platform and not just focused on a particular part of it. And we're filling as many of those subscribed seats as possible. So those are all the efforts. I mean, we're heavily focused on utilization of those seats.
Yeah, I think just to jump in on this one, I think some other strategies that we're seeing work. In some instances, there may be a net reduction, what I'll call soft churn in. So I want to keep the relationship, but I want to move from 100 seats down to 60 or whatever the case may be. And there are other revenue streams. This is from a revenue retention perspective, potentially. You've got managed services, depending on your model. You might have other products too. So that's one thing from a CRO seat. Finding the ability to add incremental value to the customer, potentially maintain your revenue profile, but provide incremental services or solutions that helps them get more out of this product is another potential mitigating effect. I think the big thing is avoiding hard churn at all costs, right? Where you lose them because then you're going to be over 2x your CAC, right? Because you got to go back and get them again. So yeah, there's a spirit of flexibility that I think we all have to have in helping our customers through this tougher period, but also, still trying to maintain some level of revenue consistency as we do that.
That's absolutely right. So here at Alloy, first we sort of asked ourselves, is Alloy critical infrastructure? And we were convinced it was, because, what we solve is identity verification that's in many cases required by law, KYC, anti-money laundering, etc. And then fraud reduction. Fraud has just exploded over the last 3-4 years in the context of financial services. So, okay, once we realized that, we said there are a few types of customers who churn. One are very young, small customers. Potentially, they can't raise money in this environment. You can't do much about that. And then there are others who may have not implemented Alloy correctly. So in that case, the approach is very flexible to re-implement and so on. And a third category would be those who over forecast how quickly they might have grown or they would grow. Like this is back in 2020, 21, and they probably give us a huge commitment. And they are not anywhere close to the meeting that commitment of usage. So with them, we just work with them and redo the contract. But the overall approach is to be very flexible and to get the customer align with the customer success and make sure that the pricing and the contract terms reflect that. And we're all taking a long-term view that, a customer that's healthy will be with Alloy for a long term. So there's no need to nickel and dime in this environment and just work with them.
I'll also add that we've experienced a lot of layoffs in our enterprise accounts. So we've actually jumped into those individual affected folks, and we put them on free plans for 6 months to actually create that goodwill. So when their career comes back, they find a new employer, they go out on their own, that goodwill is there and they'll pick us up again and start paying.
That's a great call. Yeah. In our ecosystem, as we're seeing reductions within organizations, or if they're moving around who the administrator of our products are, we're leveraging the ecosystem, the Spiff ecosystem to try to connect them with potential folks hiring. But you can't underplay the value of goodwill in a period where your customers are under certain strain.
That's right.
I wanted to jump back to one comment, Steve, on sales hiring, just because I
meant to ask you about that.
No, it's okay. It's more one idea. If there are some sales leaders out there that, in the early cloud days, it was like literally Wall Street is going, when we were public at Cornerstone, tell me how many AEs you're going to hire, because that's going to tell me how fast you're going to grow. And we've gotten a lot more predictive, a lot more data, a lot more solutions in place that'll help us be smarter than that. But there was, that was once like the focus. And I guess what I'd say in this year and what I'd throw out to sales leaders is contemplate the right, because if you're going to spend, call it $250,000 on an FTE, right? Whatever the number is, 200 if it's fully burdened with taxes, et cetera. This may be the time to add that incremental enablement hire or operations hire, or maybe a channel or alliances hire that may or may not hit the 400, 500, 600K quota directly that you have out there, but can kind of lift all boats, that can ensure onboarding, speed to productivity, can ensure higher pipeline across the current team you have right now. So it's still a go-to-market or a sales hire, but it may be a good time to pivot that resource for one that can help all teams become more effective in that sense. That's one kind of alternate strategy to just not hiring or strictly hiring quota carrying street folks.
Let's pause and take a question from the audience that I thought was interesting. The question is, how can finance leaders respond to pushback from sales leaders who argue that over-focusing on metrics or relying on outcomes to make decisions can be distracting and pigeonhole sales and go-to-market strategy? Any thoughts on that one?
Yeah, I would say, okay, it's a negotiation, right? Okay, how much time do you need to prove something out? Because these metrics are important. As a sales leader, you need to know what S&M magic ratio is, what your CAC payback is, what's your ramp period for each of the segments, what's the sales cycle, all those things. And in many cases, I would say, it's not one aspect of operating efficiency is to improve those metrics. And the other aspect is hiring sellers. So, my negotiation is always back to, let's agree on some metrics that are not operational efficiency in your understanding, which is all the things I mentioned formally. And then if you're not hitting those numbers, I'm going to come back and say that you need to reduce your hiring or get rid of underperforming sellers, etc. So bottom line, it's always a negotiation. It's always the best of sellers, as Matt would know, do want these operating efficiency numbers to show that they're not only hitting the numbers, but doing it in a very a fiscally responsible way.
Yeah. And depending on where you're at stage wise, so I'm not sure where Gabriella's organization is series wise or raising money, but not just the fundamentals of business are the fundamentals of business. You can only survive so long growing revenue at all costs where you're losing, a ton of money. It only goes so long. That's why you oftentimes raise venture funds. But even when you're contemplating your next raise, these efficiency metrics are going to be in the deck. They're going to be in the questions. You're going to be asked them. And as the sales leadership, you have to stand up with a level of confidence and say, here's where we're at, not just growth wise, but efficiency wise. And here's our plans to continue to maintain that efficiency at a higher growth rate or improve our efficiency. And I can just, make sure your sales leadership understands it's not just a finance issue. It is a CEO and a who's going to invest in you issue. If you're already profitable, and then it's up to you as a business, how much of that profit you want to spend on growth. But I will say, if you're in a venture environment, you're going to be held to these metrics rightfully because they represent long-term business health. It
also points to the importance of the infrastructure to get good data and accurate metrics out. So a lot of the challenge I have with my counterparts is when I don't have good data, we're kind of guessing and it's not effective. So that points to a good CRM, having Ordway in place, having a good revenue management system, so we actually know what's going on and we can point to those things.
Interestingly, sorry, John, go ahead.
No, go ahead, please.
Interestingly, not in this company, this is different company. In my past, my biggest argument on the topic that Gabriela mentioned was with the CEO, not with the head of sales. Some CEOs believe that you can hire and get out of your problems by just hiring a lot of sellers. And I've always pushed for first principles. Let's understand why the existing sellers are not able to sell. And usually it's a product issue. So go back to diagnosing why your product is not selling for a certain segment and so on.
Yeah, well, and as unfun as slowing or growing slower might be for a sales leader, there's nothing more unfun than having to let people go. Like it's a scenario you don't want to end up in. And you think about the time and money wasted when you scale up too quickly, 6 months of underproduction. It's a lose scenario. The business loses, the AE who maybe didn't get a fair chance because you moved too quickly. And then you've got to deal with the management and leadership challenge, which is, oh, we're shrinking after we move too fast. So I do agree, Kieran. Having been there enough times, you have to take it one step at a time. There are times in the market when it's time to grow more aggressively. It's just right now may not be one of them, depending on where you're selling, of course.
So just adding on to that question on the topic of metrics, what you guys each kind of referenced this in the first question I asked, but what are the top 3 metrics your executive team is focused on right now? We'll just go around kind of quickly. Matt, you mentioned ARR.
Yeah, we're measuring very aggressively to monthly ARR trend. How's our total ARR trend against the month? I'll speak to what I am most focused on with my CFO, and then he's got a few as well. And in ARR trend, it is new bookings, it is expansions, and it is churn. So kind of the net bookings and churn number, net expansions and churn number, and the total new bookings. We're watching closely to, how quickly we're getting from the booking to revenue, meaning, are we pushing kind terms out there to try to attract people in that could create a delta between those two. And I do know, we are measuring churn, cash burn at the CFO level very intently as well. And I guess as I think about new bookings and expansions, NDR is a core area of focus. So it's kind of like ARR sustainability and growth there, NDR to ensure we're continuing to see higher, outcomes tied to the customer base, and then cash burn, I would probably give us the big 3.
Mm-hmm.
John, how about you? You talked about getting the CRM cleaned up, source of leads, conversion. Any others?
Yeah, churn is obviously number 1 for us. Obviously, looking at contraction, expansion, and real churn, and understanding the progression of MRR on a monthly basis. So, what is the source of MRR growth and turnover in the MRR? And then, as we talked about earlier, all the metrics around the sales process. So, cadence, conversion, all the aspects relative to getting a trial ultimately to a paying subscription basis. All of those underlying metrics are critical to us.
And Kieran, you talked about new bookings, GDR, NDR, cash burn. Are those the 3?
Yeah, those 3. So it's new bookings ARR, which is fully with the sales team. Ending ARR, which is a combination of CSMs and sales. And there, as you mentioned, Steve, GDR is very important to reduction of churn. The third is cash burn. And so across the company, across the whiteboards, we've pasted these 3 numbers so that everybody knows what these 3 numbers are. Operating efficiency is sort of like an umbrella initiative, cross-functional, and cash burn is impacted by operating efficiency and so on. That's how we are operating.
Yeah, we also watch CAC, our customer acquisition costs, very closely. We're very fortunate. We have a ratio of 8 to 1, but we also look at the life. So we fortunately, again, have a very long life. It's over 5 years per subscriber. So we've got our finger on that as well. So those are all key metrics that sort of mix into the batch.
Yeah, and I agree with John on that. Inside sales in the ARR, growth number, efficiency metrics, magic number, pipeline coverage, win rates. Like, we're going one step down to ensure we're keeping a close eye on, are we, is there enough business out there that we're putting in the hands of our sales teams to be successful? And then how are their unit metrics and, down to team level, individual level at efficiency of close, and then overall sales efficiency as well, kind of marketing and sales spend for a period over net new bookings for a period. And that one you want to have above 1 wherever you can. So, the magic number there too.
Yeah. For us, a couple more metrics that weren't mentioned here that we also track are gross margins, and we have different types of gross margins. That's one. And within that, we are looking at professional services efficiency. So staffing, utilization, how much revenue can we charge? Even though we are all ARR businesses, people don't value professional services revenue. But guess what? If there are bigger customers that have the ability to pay, why not charge? It impacts your cash burn, of course.
Lots of good metrics. So some of these kind of clearly fall in the domain of finance, like cash burn and gross margins. But I'm curious who in the organization owns reporting on the ARR, or things like the professional services efficiency, some of the lead conversion rates. Do you guys all have a RevOps team? And if so, does that report into finance? Does it report to the CEO, COO? Does it report into the CRO? Maybe start with you, John.
Yeah. So in the smaller companies, like when I first got to MBS, 20,000 subscribers, RevOps actually reported to me as CFO. And as we grew and we brought in a COO, we shifted it over to the COO. So I think it's just a matter of size and where the company is and where it logically reports. But I control all of the metrics. So I dictate what the metrics are we should be watching, and working with the CRO, the COO, and the CEO, what systems need to be in place to get us that data.
Matt, how about you guys?
Yeah, it's funny. I just had a conversation with our co-founder and COO about this, who has spoken to, our investors, and in the, call it the Series A to Series C run. I've seen every combination you can imagine: centralized, decentralized. We were joking about it. They've gone from decentral to central and gone re-decentral, because you have needs for marketing operations. Obviously, you've got sales operations, you have finance operations, and of course you have customer CSM ops, and they all have needs around CRM and around processes. Mm-hmm. We're currently decentralized, but with, I think, fairly strong governance across those teams to ensure, as we're making any changes and turns in core process or in CRM, we're thinking, kind of upstream and downstream. So we've got a sales ops, a small, mighty sales ops team of, 1.5. And then there's a client ops, and then there's marketing ops, and then there's finance ops. And those teams collaborate pretty consistently on understanding upstream, downstream. I mean, ultimately, to John's point, I think the targets that we focus on are, owned by the COO and myself and the CEO, kind of the exec team. But then we've gotten pretty good at, measuring and finding those points where there could be friction, or where we can collaborate to align on a process that works, for both sides. But yeah, it's a decentral type environment at this point.
And Karen, where is it in Alloy?
So at Alloy, we hired a very talented SVP Ops who reports to the CEO. And the evolution is interesting. When I joined, maybe 2 years ago, I had a chat with the founder on where I think RevOps should be. At that time, I said not in finance, because I don't want the sellers to think of RevOps as just an enforcer. Like with finance, sometimes they're intimidated, right? I wanted helpers who are also neutral arbiters of, based on data. So that's why I said, and also I did not want under the head of sales because I wanted an independent organization. That's how we evolved. Now it's a very powerful organization. Under our SVP Ops, we have RevOps, CS Ops, Marketing Ops, BI, Biz Ops. So it's expansive. But they're very close collaborators with my team. And, I would say I set the metrics that are important. I am constantly looking at maybe there's a different metric in this environment. For example, committed portion of ARR, which is more important now than uncommitted. So I set that direction, and my team finance collaborates with RevOps to get it implemented. But RevOps is responsible for making sure, it's in Pigment or Salesforce and other, it's, distributed out to the sales and other GTM teams and so on.
So a lot of good questions coming in the chat. Let me go back to some of the ones that we had planned, and we'll get back to these questions in the chat in just one second. But I wanted to ask about commission policies. Ordway, we're a billing company, and I think most SaaS and cloud providers have gotten used to collecting at least 1 year payment up front. But we've definitely seen a trend with a lot of our customers where over the past couple of months, we've seen a lot more semi-annual payments, quarterly installments, even some agreements where there's month-to-month, monthly invoicing on an annual contract, which kind of begs the question of, thinking about sales and finance alignment, if you're collecting the money in 4 quarterly installments, do you still pay the sales rep's commission up front 30 days after the deal's closed, or do you start to align the commissions and the collections a little more? Interested in folks' thoughts on that. Maybe we'll start with Kieran.
So we've evolved from a state of the union when I joined, when it was just monthly collections and we didn't pay attention. And I said, look, we need annual upfront, to last quarter where 95% of our new bookings were all on annual upfront. And to get there, we gave an incentive to the sellers on the annual upfront fee, and that was enough to kind of change behavior. Also, the other evolution was, I was thinking, okay, what if they don't embrace it? So I tied their commission frequency to the invoicing frequency. So if it was a monthly invoicing, the commissions would be paid monthly. And then I realized after a year, it's just too much to maintain, and they were changing their behavior on their own. So for this year, all of our commissions are paid upfront, regardless of what the invoicing schedule is. But in instances where the customer might say the service start date is 2 months out, then we just delay the payment of that. Mm-hmm. So that seemed to have done the trick for us, actually.
Someone just asked on the chat, I'm not sure if you're comfortable sharing, Kieran, but what was the incentive you used to drive people to get the annual upfront payment?
Yeah, no problem. 1% of the ACV. And now for CSMs, for the upsell portion, if they convert a monthly to an annual, just for the incremental piece, we pay, I think, 2%.
Nice. There was another question a few minutes ago in the chat related to commissions, and it was, do sales leaders at your companies have any comp tied to NDR or cash burn so they don't get misaligned bookings that later churn, in the spirit of total GTM alignment? Any thoughts on that one?
Yeah, I'll jump in for our sales leaders. Not today, meaning, it is still a net new growth scenario. They do participate in a full year of expansion on the deal they bring in. So if they bring in a deal that grows, there's added incentive and quota retirement there. What we do, though, is have pretty consistent conversations around ICP, around when is it too small, which industries do we not want to dip down to, and we will, apply minimums and not quote, not participate in certain deals, and just have those conversations with the sales team. It's an interesting, I think in our moment in time, we naturally want to keep our foot on the pedal of growth, but good growth. That said, we're measuring our churn very aggressively and consistently around the types of industries and organizations. And we will ensure if we're bringing any of those on that have shown higher churn than others, that we have strong terms. So, back to what, Kieran was saying, that those are minimum 2 to 3 year deals, annual upfront, that we're going through a couple other vetting stages to ensure during the sales process, not just we'll get them in and get them sold, but there's a higher chance of them retaining and staying with us. But the quick answer is no. Right now, at the sales leader level, I don't have NDR or cash burn tied to the outcomes there.
Yeah, we're the same at MBS. It's all based on bookings. There is a clawback aspect if there is churn, but we have very consistent retention. So we've got high confidence when we sign a new account that they're going to stay. And that's what we base comp on.
Yeah. And ironically for our commission plan this year, so Kieran, my team's going to like you better than they like me, but I just migrated to, we've done a great job with annual terms, but with the cost of capital and people potentially delaying payments, I partnered with finance this year and said, hey, if you sell a quarterly deal, you're going to get paid quarterly. You know what I mean? That's just kind of be the way we do it. We'll see how it goes with this year's campaign. We already had, I think we were right around 90% annual upfront, and we're hoping to continue to maintain that even in the spirit of, or in the current environment. But did tie the AE outcomes to their ability to get that item in their agreements. So we'll see what the impact has.
Yeah, I agree with those, what John and Matt said. The one thing that's the reason why we don't put all this efficiency cash burn on the seller side is because, like I mentioned before, our SVP ops is very strong. So it's sort of like, the deal desk is very strong here. So we have the ability to kind of control deals, or, in some cases say no to deals. In many cases, say no to month or quarterly, just push annual upfront. That's the reason we've brought it back into the ops, rev ops function here.
That's great. Just kind of adding on to that, Ordway being a billing company, we've seen a surge in requests from our customers for, getting them help chasing cash. A lot of them are telling us, net 45s become the new net 30. People are just dragging their feet on making payments, and they've got more delinquent accounts certainly than they did a year or two ago. Just thinking about commissions and all the things we were talking about over the past few minutes, is there a role for customer success or sales to play if you've got a delinquent account where commissions have already been paid? Does the sales rep or CSM get involved to help try to collect that money, or does it kind of purely stay in the finance and accounting world? Maybe John, be interested in your perspective on that.
Yeah. So on our B2C side, it's all credit card. So those are all automatic. So we don't have collection issues there. But on the enterprise side, when there is an issue, and normally it doesn't start with non-payment. We normally get questions about how many subscribers, how active are we, what's our usage reports, and so forth, before we even get to a collections issue. So we're already deploying the management of that account to our sales rep and to whoever has that relationship, as well as our customer success team to get involved even before it becomes a payment issue. Payment is sort of it's late stage. If there's going to be an issue in an account, that's pretty much at the end of the cycle for us.
That's right. So for us, it's a joint collaborative effort between finance and CS. And I make sure that I attend every meeting. It's a bi-weekly meeting. It's not just for payments. We call, every at-risk account. And at-risk is payment is just one signal. Not using the product as much as they should is another. Going completely, silent, radio silent on us is another. But we elevate all these discussions at the board level. And in our board meetings, we identify every at-risk account. In many cases, if customers have a payment problem, we work with them to do a payment plan and things like that. So that conversation is driven by finance because we have all the AR aging data and so on and so forth. But the CS leadership are the ones who act on it.
Yeah, it's a great reminder. The customers to worry about from a churn perspective are not the ones obviously on the product all the time, or the ones that are concerned and raising issues. It's the ones that are not using it and not saying a word. There's your churn risk, which we've all learned the hard way. I think on the collection side, it's co-owned between CS and finance. I will say what we've done a good job of, though, we still look at the AE as the commercial, the commercial front end representation of the business. And when there is, delayed payment or lack of payment, they're informed, and also it's mainly sales leadership. So I'm trying to keep our AE, frontline AEs, whose job is our net new acquisition, out of those concerns. But when there's escalations, sales leadership will get involved, and really with a focus on, hey, for us to continue to deliver on implementation, CS, whatever those resources are, we're going to need to get payment, or at least have, to Kieran's point, an agreement on when and how you're going to pay. So it's kind of third line of defense to ensure that sales really stays focused on bringing in new business.
We've got about 10 minutes left. Why don't we take a couple more of these questions from the audience? One of them, I think, be interesting. How do you compute CAC? Kieran or John, you want to give kind of a quick overview, maybe not only how you compute it, but why it's important?
Sure. Yeah. So CAC, in my mind, it's obviously all your sales and marketing cost used or utilized in obtaining that new account. And it's not always scientific to be able to track it, but we do the best we can to determine what it is. And the industry metric is LTV to CAC, lifetime value to acquisition cost, is 3. That's the goal. So anytime you're at that ratio or better, you should be doing okay on your recovery.
Exactly. Just to add to that, we margin adjust for LTV. So we multiply, ARR contribution by the product gross margins. Some companies don't do that. Some companies don't. And that's also fine. It depends on what type of, why the metric is important and what decisions it's driving. So for us, margin adjustment was important.
Kieran, can you just elaborate on that a step further? Like, I'm asking live on a webinar. So why do you do that, and what's it help you understand better than doing it without the margin adjustment?
Right. So for example, if you take CAC payback is the first derivative metric from doing CAC, right? So that means, if you spend $100 in CAC, how long does it take you to recover that? Right. For that, you have to do, it's on a cash basis. So if you multiply ARR by margins, then you get more of a proxy for cash. And so you can do the CAC payback. Similarly for LTV, we kind of say that, look, you can get away with that by, if you're like a typical SaaS business with 80 to 90% margins, you could say, okay, fine. But if you're not, then you have to margin adjust so you have a really good sense for what your LTV or CAC paybacks are.
Awesome. Thank you.
Another question on the metrics we got was, do you track industry KPI benchmarks? And if yes, how do you do that? What's the source of information? Any thoughts on that one?
Yeah, we do. For us, we are in the $50 to $100 million ARR range. So Bessemer has a really good set of metrics, and Bessemer is on our board. And there's iconic metrics. So there's a bunch of metrics that we track. So for the board, as well as for management, we track and report on a monthly, quarterly basis.
Yep. Similar scenario. I believe our CFO keeps the closest eye on the bulk of them, our co-founder. But on the sales side, we're certainly measuring, KPIs for our stage 2 for kind of sub 50 million ARR efficiency, total ARR created over cost, and magic number, as mentioned before. We're keeping a close eye on that. 2-quarter trends as it pertains to efficiency and effectiveness from a sales perspective. And like the benchmarking in sales might be more what percentage of pipeline or ultimately created ARR is self-generated versus comes from marketing versus comes from. So we do a lot of peer and benchmarking measurements there to ensure we're in the right range from an efficiency perspective.
Yep. We do the exact same thing. We're a little bit smaller, so we're sub 50, but all those, whether it be SaaS metrics or, there's dozens and dozens of sources that we're constantly looking at to try to get those correct measurements. And we're talking to bankers and our peer group and so forth, just to make sure we're tracking the right metrics and that we're looking at the benchmarks.
And they change, I will say, too. They don't, not overnight, but it does seem like, well, let's just say the metrics are all there, but depending on the nature, as we started with 18 months ago, the metrics that were the deepest of focus have adjusted slightly, for sure.
Well, I'd also add, I think we tend to overcomplicate them. So there are really like 5 to 8 core metrics that we ought to keep our hands on. Yeah. And a lot of times we get into these meetings where, overeducated folks want to look at 35 and you get lost in the numbers versus the core 5 to 8.
Yeah, 100% right.
Yeah.
To me, in my mind, when I look at the 35, 36, this, I'm like, what is the story I want to tell about the health of the business? What are the 4 things that will tell me the story about the health of the business? So I just try to distill it down to the 3 or 4 or 5 or 6 at most. That makes sense.
Yes, 100%.
Yeah, it's definitely overwhelming. One more question. How are you guys thinking about travel? I imagine, now that we're in March, you've had a sales kickoff, some of you might even have a president's club type trip for the sales team. With the downturn and the focus on budgets and stuff, are you still sending people out for face-to-face meetings for big sales opportunities? You taking people out to dinner, building relationships, or is that stuff kind of on hold just given budget constraints?
Well, I'll openly offer to take Kieran or John to dinner if we can talk about commission.
I'm in.
Yeah.
And this is where, on this topic, Matt and I would be best friends.
Right.
Matt,
right. Just to quickly share, we did do a go-to-market kickoff this year. We decided not just to do sales, so we had kind of all market-facing team members. Very successful event. Spent some money on it, and everything went like clockwork. It felt like old times as it pertains. And I did have a sense of, part of, I think, being the go-to-market motion. There's something in human energy and being together that everyone benefits from, and the camaraderie and just, the depth of communication you can gain by being together in one room and then getting into breakout groups. So it was very worth the investment. We are doing club as well. It's a smaller group. We're a smaller organization, but I think it's a smaller group too, going. But I think just in general on the travel topic, I during kickoff mentioned to especially my enterprise sales team, the buying process over the last 3 years has moved remote. One of the biggest deal I've ever been involved with, 4 million a year, 12 million TCV SaaS deal that we did, and we did it in just shy of a year, completely remote in 2021. So that, and we're talking one of the biggest companies in the world, and that's how they have gotten used to buying. So the other thing is, even when you're selling into mid-market, buying teams are distributed now because so many of us have joined in a virtual environment over the last few years. So going out and seeing John Smith, or whoever it might be, that may help you, but there's 4 other people involved in the decision-making process who won't be in the room. But I have said to my team, for the right meeting and the right conversation, we want to build customer trust early, and we want to ensure we, as deeply as we can, understand what success looks like for them. So for my enterprise team, I'm saying, for that key meeting where the buyer is open to that and it makes sense, let's spend the $1,000 for the trip, whatever that may be. I believe it'll influence win rates, and at the very least, it could lead to a better implementation because we've taken that extra time to really, do more than just what a 1-hour Zoom call might allow us to do. So,
yeah, for us, travel hasn't been an issue. We fortunately have been selling remote for years. The impact to us was we do a lot of seminars, large seminars, where we can have anywhere from 2,000 to 20,000 mortgage loan professionals in a room. And those were halted during COVID. We have brought those back. They're very effective selling events for us. So we do sponsor those and put people on the road as much as possible to hold those kinds of events. But we wouldn't hesitate. We've also utilized a lot of webinars. So in our enterprise accounts, we do pretty large monthly webinars to encourage that usage, bring new data to the forefront, teach them about the markets, that sort of thing, to encourage them to use our platform.
Yes, similarly, big supporter of travel. From a culture perspective, as I mentioned, Alloy is a frugal culture. So I'm the CFO that says, go out, spend, especially for prospects, not like tentpole events, but we do a lot of these happy hours or smaller dinner get-togethers and so on. So one lesson that we learned was, at a big event for our industry, we did not do a booth. Rather than that, we went out, booked a restaurant, and brought lots of prospects and existing customers. That worked really well. Yeah.
Mm-hmm.
Good. Well, we're at time here at the top of the hour. There's a few more other questions that I was hoping we'd get to, but we've run out of time. Thanks so much, everyone, for joining. As I mentioned at the beginning, we will be sending out a link to the replay recording of this session if you joined us late or had someone else you want to share it with. Look for that in your inbox from Spiff here in the next couple of days. And thanks again so much, John, Karen, Matt, for investing this hour to share with us. I know it's a busy time here at the end of the quarter and with everything going on with SVB and others. So really appreciate your time and your insights.
Yeah, enjoyed it. Thank you
Thank
all.
you very much.
Thanks, everyone.
Thanks, everyone.
Bye.
And good luck closing out the quarter.
Thanks, Steve.